Hello class. Today's lesson is all about the Cashbook. In our previous discussion, we talked about the books of original entry, whereby we talked about the sales journal, and we said it is normally used to record only the credit sales. We talked about the purchases journal, whereby we said it's used to record only the credit purchases. We talked about the return inwards journal, which is normally used to record the sales returns. And we also talked about the purchases journal, which is normally used to record the purchases returns. Another source document, book of original entry that we have, it is actually known as the Cashbook. And the Cashbook is said to be a book of original entry, and at the same time, it is a ledger account. And in all the discussion that we said about the other journals, the four of them, we talked about it is only meant they are only meant to record the credit transactions, that is either credit sales or the credit purchases. Somebody might wonder, what if the sales or the purchases are made on the cash basis, or they are paid by check immediately? What will actually happen? These particular transactions are going to be recorded in now what we normally call the cash book. The cash book, just as the name itself suggests, it is used to record transactions where cash is received or cash is paid immediately. Therefore, here you can be able to see the cash book, it is meant to record receipts or payments in form of cash or checks for a particular financial period. Then you are going to see that in the cash book, we are going to have either money being affected, which is actually the cash in hand, or the cash at bank. Either we are paying money in form of cash, or we are paying money in form of check. On the same note, either we are receiving money in form of cash, or we are receiving money in form of checks. So in the cash book, we are going to have two sides. We have got the debit side, which normally records the receipts, and we have got the payment side, which is also known as the credit. And in that particular case, we can start by looking at the types of cash books. We have got different types of cash books. Actually, they are four in number. We have got the single column cash book. We have got the two or the double column cash book. We have got the three column cash book, and we have got the petty cash book. But let us start with the one column or the single column cash book. It is called the single column cash book because this cash book, either we are going to prepare the cash account, whereby we have only the cash here, or we have got the bank, meaning that this is a cash book whereby all the cash transactions are recorded separately, and all the bank or the checks are recorded separately. If they are recorded separately, then they are known as the single column cash book. Actually, the single column cash book, it is like a cash account and the bank account is maintained separately. So how about the two column cash book? I don't want to go more about the single column because so far we have talked about how to prepare ledger accounts. And in the ledger accounts, there is no single day we fail to talk about the cash account and the bank account. It is simply actually the date, the details, and the bank. This is the actually when money is received. And on this side, it is when checks are paid out. The same case here. With the two column cash book, instead of having them two separately prepared, they can be combined. So that on the receipt side, we have got the cash and the bank being combined here. Instead of having cash separately and bank column separately, they are actually appearing both here. On the payment side, instead of having this one and this one in separate accounts, they are appearing both of them here. So when they are combined together, then they qualify to be called the two column cash book or the double column cash book. When we go to the third type of cash book, which is the three column cash book, we introduce the column for the discounts. More often, when you talk about money being received in form of cash or checks are involved, you'll find that there's what we call the cash discount. Cash discount, it is normally given to the buyer so that he can pay the amount within the shortest time possible. So the discounts that we are going to talk about here, they are actually the cash discounts. The cash discounts. Remember here, we are receiving money. That's why it's called the receipt side. Because we are receiving money, it is our obligation to give the discount. That is why it is called the discount allowed. Discount allowed because we are allowing it to our customers is going to be on the debit side. Then on the payment side, we are going to have the discounts received because we are the one who are paying, because it is our business that is paying out. So we expect to receive discount from the person to whom we are paying. And then now we can move on and see how do we prepare this actually for a purpose. But first of all, before we look at how we prepare it, we can look at the purpose of keeping the 3-column cash book. For accurate recording of cash discounts that is allowed and the discount received, accurate recording of cash and check received and paid, record opening and closing balances at the beginning and the end of financial year respectively, and helps to detect errors and fraud. Note that when we talk about discounts, we have got 3 types of discounts. We have got the trade discount. Trade discount is normally given to traders, and a trader is the person who buys goods with the intention of reselling them to earn profit. So you give these people discount so that they can be able to get a higher profit margin. Then we have got the quantity discount. Quantity discount is normally given to people who buy goods in bulk, who buy goods in large quantity, or to motivate people to buy goods in large quantity. The more you buy, the higher the discount. That discount that is attached to the quantity that you buy is known as the quantity discount. And now in this case, our focus will be on the cash discount, which is actually classified as either discount allowed and the discount received. Discount allowed is allowed to the customer. So instead of your customers paying you a certain amount, they pay less. That discount that you give them is discount allowed. The same case, if you are supposed to pay your suppliers and then you are given a sort of discount, if you pay within a shorter period, then that discount, because you are getting it, it is discount received. Cash discount, it is meant when you pay for the goods as soon as possible. Now, having explained that, we can look at an example here whereby you are told the following details belong to JJ Wholesaler. Prepare 2-column cash book for the month ending this. It is very simple. Remember, we have got 2 sides. We have got the receipt side and we have got the payment side. The first case here, it is either the business is starting or the business is continuing. If the business is starting, you will be given what we normally call capital, or the amount of money that was used to start the business. So in this case, the business started with capital in form of cash, 100,000. You'll find that that is a receipt to the business. That is a receipt to the business. When you come to this cash book, you will find that it is going to be recorded as a receipt here on the receipt side, because the business is receiving money from the owner. Then the next transaction is that paid rent, 10,000. Once you pay rent, it's with a payment. It is a payment. So you'll find that it is going to appear here on the payment side, rent of 10,000, and it's actually in form of cash. So you look at the form of payment or the form of receipt. If it is check, you put it in the bank. If it is cash, you put it in the column of the bank. The next transaction is that received loan of 500 via check from Barclays. We received, so it's supposed to be on the receipt side. So what you do, you come here and you record it as a receipt. That is bank loan. Because it was checked, you record it in the bank column here. The third scenario, it is a paid Kenya Motors 65,000 by check. That is a payment because we paid, and because it's a check, you come here, you write Kenya Motors 65,000 on the bank column because it was in form of check. You continue like that. You have the next transaction, which is made cash sales. Once you made cash sales, you are selling, so you are receiving cash. You are receiving cash, so you come here on the receipt side, you record the sales and you record it in the cash column because they were cash sales, like that. So anything that you receive, you record it on this side. Anything that you pay, you record it on this side, like that. And then at the end of the day, the Receipt side, cash column, if you add these figures that are on the receipt side here, they will give you the total amount that was received. And on the cash of the payment side, it will give you the total cash that was paid. If you subtract the total cash that was received and the total cash that was paid, it gives you the balance carried down of 184,000 like this. This is the total for this and the total for this up to the here. And then now you minus, you get this is the amount that was the balance. And then if you insert this balance here, the total for this side and the total for these sides are going to be the same. You do the same to the bank. This is the total checks that were received, and this are the total checks that were issued. The difference between the totals that were received minus the totals that were paid, they give you the balance in the bank like that, like that. And then now the total for this column and the total for this column, they are going to be the same, like that. I want to draw your attention to this transaction on 16th. On 16th. On 16th, we have took cash or took 50,000 out of cash and deposited it to the bank. That kind of a transaction is known as contra entry. A contra entry transaction, it is a transaction that affects cash and the bank at the same time. Money is taken from cash and deposited in the bank of the same business. That kind of a transaction is a contra entry, and it's going to affect the both sides. So on 16th here, if you can have a look at it on 16th here, it is going to appear on the receipt side and also on the payment side. That figure 50,000 and here 50,000 is going to be the same. On the receipt, it is the bank that is receiving because it was taken from cash to bank. So the bank is receiving here 50,000 and the money is coming from cash. On the same date, the cash is paying. Cash is paying 50,000 and that money is going to the bank. You can also see another transaction here on 30th and here on 30th, like that. But in this case, on 30th, it was money that was withdrawn from the bank and deposited in the cash box. On 30th, it's here. Withdrew 100,000 from bank for business use. Anytime you find it is for business use, it is actually taken to the cash box. Or for office use, it is the same. So in this case now, it is the cash that is receiving. The cash is the one that is receiving. That's why you come here. That's why if you come here, that 100,000 is recorded on the cash column and the money is from the bank. And it is the bank that is paying and it is going to the cash. That's why you find that it is 100,000 and it is going to cash here. On the payment side, details here, it records where the money is going. And here, the details of the receipt side, it records where the money is coming from, like that. I hope you have enjoyed. Have lovely moments. Thank you.